Hey, how's it going in this video? I'm going to be talking about quantitative easing and what that is. Quantitative easing is a monetary policy tool used by central banks to stimulate the economy. Then, traditional monetary policy measures such as lowering interest rate have become less effective. It involves the central bank purchasing financial assets, typically government bonds or other securities, from the open market with the goal of increasing the money supply and lowering long-term interest rates. Let's take a look at the process and how quantitative easing works. Asset purchases. A central bank, such as Federal Reserve, private company, in the United States, decides to buy a specific amount of financial assets, usually government bonds, from banks and other financial institutions in the open market. These purchases inject money into the financial system. Increased reserves, then the central bank buys these assets. It creates the accounts of the selling institutions with newly created reserves, effectively adding money to the balance held at the central bank. So Federal Reserve, which is a private company, makes money out of thin air, but to create value, they they do a lot of interesting things to create value to money that was just printed, I guess. And they will try to find the people who might be interested in investing with the promise that they will return more, or perhaps taking on some of the assets on their balance sheets in return. By doing that, perhaps they will try to create some value to that from the thin air that they just made, in other words. Lowering interest rates. As the central bank buys substantial volume of government bonds and other securities, it increases the demand for these assets, the supply and demand. If we were to take a look at the example, right? So diamonds, right? Diamonds do not really have any value unless there are a lot of people who are interested in buying diamonds. So whoever is producing diamonds, they always need to keep control of how many diamonds are in the market, right? People who finding diamonds or digging for diamonds or having a lot of access to a lot of diamonds, they controlling diamond market, right? So this is what Federal Reserve is doing, right? Diamonds themselves do not have any value, right? They do not have any value, right? So this is what's really happening, as well as they're currently doing a lot of shady things with overall securities and what is to be considered to be security, as well as how they can lend money to private individuals or companies to buy securities, and later by doing a lot of shady things can take hold of all the securities that they lended money to purchase in the first place. So there's a lot of books published on this particular subject, and how all the countries, not necessarily limited to US, but in Europe, how they can take a hold of those securities and making value of nothing, actually get a hold of securities and buildings, businesses, you name it. Either way, let's come back to what demand for assets are and how Federal Reserves can drive up their prices. Then bonds prices rise, their yields, interest rates fall. This results in lower long-term interest rates for a variety of financial products, including mortgages and corporate bonds. Encouraging borrowing and investment. Lower interest rates make borrowing cheaper, like 2%, 4%. Currently, we are at around 7%. Borrowing for what? Borrowing with the promise that we're gonna. This is what government's doing, right? So government's borrowing money with the interest rate. So how can you return all the money that you have borrowed? That's what I'm really interested in. So you're borrowing money from a private company with the promise that you'll give back more than you have borrowed in the first place. That current system, whoever works on this current system, can answer this question. I'm interested in that. How you can do that to a private company. Uh, This is in turn can stimulate spending, investment, and economic growth. Yes, it stimulates. It stimulates that the people pay money to Federal Reserve in return to a private company, uh, which is a very interesting idea. Whoever came up with this idea or system, that's be a very smart person. Expanding money supply. The injection of money into financial systems throughout quantitative easing can lead to an increase in the broader money supply, the value of the currency. This can provide banks with more funds to lend to businesses and individuals because the money is gonna worth less. Further promoting economic activity. Yet it does promote. It does promote. I guess this is current system. Quantitative easing is typically used during periods of economic disasters, such as recessions or periods of lower inflation. What? By quantitative easing, they're increasing inflation. So, okay, okay. Then central banks want to provide additional stimulus to the economy. It is considered an unconventional monetary policy tool and it used alongside more traditional tools like adjusting the benchmark interest rate. While quantitative easing can be effective in stimulating economy, it also potentially drawbacks have a drawbacks and risks. One concern is that it contributes to asset bubbles in financial markets. Yeah, because people would go from hard cash into different asset classes, right? So people would rather take their money or currency at the time, whatever the national currency might be, dollars, euros, and since they keep devaluing that currency, people would, from that currency, they'll move into different asset classes, right? As investors see higher returns in riskier assets due to the low yield of safe assets like government bonds. Additionally, there is concern that excessive quantitative easing could lead to inflation if it results in too much money printed for no reason, chasing too few goods or services. People, that's a recipe for disaster either way. So then the bread of can cost from $2 up to $10, right? So this is what it will lead to, and money would lose value over time. This is what's currently happening, right? But most of the people understand that. But it's worth mentioning, and myself repeating fundamentals is one way to understanding what's currently happening. And I don't know. This is what I would assume smart people trying to do their best, I guess. But some of the systems of this particular processes that they came up with, it's not the solution. Have published a course. You can find this course in the description below. This particular course is designed for people who are looking to begin or where to start when structuring their personal goals, how to approach those. But I have identified particular areas, that will be 12 areas, which I personally believe is fundamental areas where all the people should begin at. And from those areas, you would have a good, really good understanding from there how to progress from your personal professional life into developing businesses and managing a number of different projects at the same time. But fundamentals, if we were to begin at those, I have identified 12 of those, and I have prepared the course for people out there to understand those. Feel free to reach out to me if you have any questions, if you would like to learn more. I can guide you through the process. I have published PDF file as well as I made a video about it. Thank you. If if particular periods keep repeating themselves, any takeaways, yeah, from today's video, right? So if that's a monetary policy that a lot of governments looking to adapt, a lot of people should understand how much of the overall portfolio should be in liquid. That means in hard cash, dollars, euros, or that would be perhaps pounds. And if governments tend to adapt this policy of printing a lot of money, perhaps those people need to adjust their own strategy into moving from hard cash, perhaps into assets and different asset classes, right? And perhaps overall 100% of their portfolio should be allocated to different asset classes, right? So perhaps land, property, perhaps even the blockchain technologies, some of the projects there. Perhaps they have some value there. I don't know. Myself, I'm interested in hard assets. I don't know about bonds. I don't know. Perhaps it would be different businesses. Perhaps investing a lot of money there might be a good choice. But do your own research to understand it. What would be perhaps a good investment opportunities of that. Overall, central banks carefully monitor the effects of quantitative easing and adjust their policies as needed to achieve their economic objectives while minimizing the risks. So the government is on top of it, so they do understand what they're doing, which is a great thing. Government knows what they're doing with printing a lot of money, which is a great thing. Thanks for watching. I'll see you next one.